Welcome to the Broken Pie Chart Podcast, episode 290. I'm your host, Derek Moore. With me this week is no one. Jay is off this week. Actually, our travel schedules and all that stuff again. He'll be back next week. We'll talk about the Fed meeting and a number of other things. So lots to talk about today, though. All right. So I keep going back to the idea that everyone seems to be trying to talk themselves into the Fed cutting 50 basis points. And when the numbers came out, the CPI numbers, all of a sudden it was kind of a dose of reality. I'm not sure what was going on with the overreaction there. Intraday, markets pulled back near the 5,400 level. And that's been of recent times, a strong support area. And it bounced. We actually had a pretty strong recovery that day. I believe it's a really big swing. We ended the day in positive territory. And since then, it's marched up higher back towards the area of the all-time high. So good luck trying to trade this market if you're like, oh, yeah, I know I should get in, I should get out, good luck. All right. That's why we buy, we hedge. And although I'll talk about technical analysis, I'll talk about maybe the market expectations today on the Federal Reserve. Don't make this harder on yourself than it needs to be. That's why we buy and hedge. If you want to know more about that, derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correct. All right. So when the CPI numbers came out, and what I did was I took the monthly numbers and I annualized it. Like imagine if all you had was the numbers, you annualized it, and that was the run rate for the rest of the year. Okay, so the CPI, not bad. Annualized over the next 12 months, assuming you got the same rise month over month as we just reported for August from July, be about 2.27%. All right, not too bad. Now, CPI in there, oil and energy has been in a drawdown. I think it hit a 52-week low or another 52-week low. There was some news out of OPEC. I think they are maybe going to look at holding back on additional supply. I just kind of touched the surface on what's going on there. And then you look at core. So core excludes food and energy, as they say, the volatile food and energy. Although most Americans and most people around the world who are going to the grocery store are like, yeah, all right, whatever. Fine, take out food and energy. But, although energy has been down of late, food is no picnic at the grocery store. The annualized there, 3.42%. Again, that's if each month over the next 12 months rises exactly what the amount of rise just was from July to August. And then Supercore, because remember, people started talking about Supercore and they said, now you got to look at Supercore because housing is lagging and we know that housing is going to come down. I'm still not completely sure of that. I don't know that housing and rents are going to come down absent some sort of a recession. And I'll touch on all this talk about recession again. But Supercore strips out, basically it's services. That's what Supercore comes down to. And services have been rising. Remember, initially it was goods. Goods were rising in 21, 22. Now services has taken over and those are rising. Supercore is just about 4% annualized. So although CPI is getting towards that 2% level, core and Supercore has more work to do. And maybe that's why the market took that negatively. It was down quite a bit intraday and then some things reversed. And I think the reason why it was down is simply because it goes back to my example. It's when, you have your kid is like, hey, I want ice cream. You're like, yeah, okay. And I'm going to get 2 ice creams today. You're like, well, I don't know about that. We'll see. Probably not today. And then you drive by the ice cream place and it's like, wait a second, you promised me ice cream. I never said ice cream. I never said we were getting ice cream, much less 2 ice creams today. And I think that's what's happening here. Like the Fed funds futures changed. They've been wrong. And remember, coming into 2023, 2024, we're going to have what, like 7, 8 cuts? Looks like we're going to have our first quarter point cut. So I keep bringing this up because I know the Fed funds futures, and I'll, just kind of taking a look at what's going on there. When you look at the futures and you look at kind of, what it looks like, it's pricing in now 1 cut. And I will remind people, so far during the Jay Powell Fed, I would say I don't think there's been one time where going into a meeting, close to the meeting, that the Fed funds futures expect or the implied rate cut has been off. The Fed has been messaging. We've gotten the snippets. They're going to go into a dark period here where they're not going to do any talking. Powell will do his press conference. I think it's Wednesday, the 18th. Right now, it's a probability of 49% for 2 cuts, 100% probability for 1 cut. At the November meeting, it's just under. It's about a 97 probability that there'll be a 50 basis point cut at that one. Remember, pick your date. 2 weeks ago, it was 2 cuts. It was 250. It was 50 basis points. 2 25 basis point cuts, and now it's not. And then by December, they have so basically by the December 18th meeting, the implied hikes or cuts is 4.6 cuts. So this is what I'm saying. Like, the market has talked itself into getting all these cuts. I'm still not sure about it. It doesn't affect the way that we trade and we invest. Generally, we buy, we have hedges on. And you have hedges, so you don't have to try and time the market. It's much better that way, in my opinion. No guarantees the market's going to go up, but at least we have protection or buffers on the downside, some of the buffered strategies we run. So I'm not entirely sure. And, when you look at this, it's pricing in by May of 2025, there's going to be 8.5 cuts. So 8.5 cuts is basically what? That is 2.25%. They think it's going to come down to. Basically the implied rate that they're pricing in comes down to 3%. I don't know. And I'll tell you the reason why I'm not sure about this is I went and I took a look, and we're sort of in a different period right now. We've got a market that's near all-time highs. We have forward PE ratios. And again, the forward PE ratios can change because those are based upon analyst estimates, and they're based upon the price of the S&P 500. So what's the estimates for the next 4 quarters? What's the level of the index right now? You take that divided by the cumulative next 4 quarters in the future, what analysts are saying, and you get the forward PE ratio. The forward PE ratio right now is just a hair over 21. And I would say that earnings have been good. I think we're up over 13% year over year in the last quarter. Pretty darn good. And although next quarter isn't expected to be as high of a growth rate year over year, same quarter, you get to the end of the year, you get to next year, and the earnings estimates are really good. They're still really good, and they've stayed high. So I think like 80% of the companies, maybe 75%, I could be a little high on that, have beat earnings expectations. But I go back to this idea, and I pulled up a chart, and I pulled up the Fed funds rate, and I overlaid it on different axes, because it's the PE is like it's 21 and the Fed funds is over 5. You got to kind of do that. But I looked and I said, have they ever cut with a PE this high? Have they ever done that? And the answer is not really. I mean, you could make the argument at the end, August of 98, at one point let's see, when did they start doing this? So the Fed funds rate was right about 5.5 if I look at August 31st. And it looks like August 31st, no, the PE was about 19.5. And they started cutting. And by the way, they cut from what did I say, 5.5 down to 4.77, and then started raising them again as you get towards the end of the 90s. Remember the tech boom? And then I looked and I said, okay, well, what about 2000? Let's look at 2000. So by December of 2000, they were cutting. The Fed funds rate was 5.5, actually 6.5, and they start cutting. So when did they start cutting? They started cutting when the forward PE was about 21.5 back then. So there you go. Going into a recession. Unclear whether we're going to have a recession or not. I feel like everyone keeps trying to be right on this recession. Now, at some point, we'll have a recession again. I almost guarantee it. There you go. That's a guarantee. Could be tomorrow, could be 10 years. I don't know. But yeah, there's an example of where the forward price to earnings ratio was pretty high. And that's interesting because the tech boom the dot-com era had already started to collapse in March of that year. And then you look and you say, what other times did they cut? And no, it really wasn't as high. And the reason why I bring this up, it's not that I'm saying that forward price to earnings ratios are too high. That's not what I'm saying at all. What I'm saying is it's just kind of interesting that you have all these people calling for massive cuts. I'm just going to say it. They're calling for quite a bit of cutting. And the market's at all-time highs. We are not in a recession right now. And forward price to earnings ratios are, they're elevated. They can stay elevated. That's the thing. That's the problem with people trying to trade off forward PEs is you say, well, things are too expensive, but they can get more expensive. So is there a risk to the market here? Maybe if earnings or future Fed cuts or raises or all that stuff, Fed moves, deteriorates. And by deteriorate, I mean in the eyes of the beholder, they say, well, maybe they're not going to cut quite as much. I go back to what Jay and I have been saying, though, is you really don't want them to have to cut. If they have to cut, it means that either inflation's come back or not inflation comes back. That unemployment is getting out of hand, and that's really spiking, or earnings are really, the market's really doing bad, the economy's doing bad. Like those would be reasons why the Fed would react and be quick to cut. But I got to be honest with you, and it doesn't really matter what I think. I think a lot of people might have too high of expectations. They might think they're getting 2 things of ice cream, but maybe they're only getting 1. All right. I mentioned the market and kind of had that, not even calling it a sell-off, but it was just, it was a down day. It was close to a 1.5, almost 2% down day. And then it reversed until it was done. And it's kind of interesting. And I think that the market right now is trading more on a technical basis. And when I look at the chart of the S&P 500, again, I don't know what's going to happen, but you could make the argument that we are forming a cup and handle, and a cup and handle is a technical pattern. Imagine you have imagine you're looking at a coffee cup on its side. Well, not on its side. It's right side up, but then the handle is turned towards you. So like you can see the loop in the handle. And imagine you have, the dip in the cup, if you were tracing the cup and then you trace the candle. And you could make an argument from a technical analysis standpoint that that's sort of what we have right now. And if the market breaks out to new highs, you could say, okay, well, looks like maybe we had a cup and handle, and you could draw some targets and some things like that. Or we're in a triple top and we're going to bump up against resistance and fall back down here. But I was encouraged by the fact that 5,400, which has been the last 2 really bad days, including the one where we reversed and closed higher, came down to right the 5,400 and it held. And support is an area where you'd expect price to come to, find support and go back up. Resistance is kind of hitting your head on a ceiling. So we're coming up against some resistance here. kind of a third time at these levels. And we got a Fed meeting this week. So maybe this kind of resolves this week, or maybe it doesn't. Maybe we just trade a little bit of sideways here. That's a good thing about buying and hedging, or doing some of the other things we do, like selling volatility or taking in premium on some of the strategies we run here. So we'll see what happens here. We're through earnings. We're through I think there's one more company maybe that has to report. I think there's one more. And I believe other companies are, well, at least in the S&P 500, I think that's right. So the Fed meeting is coming out. And the other thing to look for that people will be paying attention to is, remember the dot plot? Yep, they're doing it. They're doing it again. So they're going to do the next year, the median rate forecast for the current year, the next year, plus 2 years, 3 years in the long run. So all those dot plots, they'll be back. And they'll probably do the employment stuff as well. And I caution everybody to put any... All right, let me say this another way. I don't want to be too hard on the Fed. Let me do it. I wouldn't put too much stock in the dot plot, because historically they don't turn out to be right. I've said this before on this program. James Bullard, I believe it was, I don't know how many years ago, there was a dot missing, and he decided not to turn in a dot. And he's like, we're really not that good at long range forecasting. So he didn't do one. I think he did one subsequently. Maybe Powell and him had a chat or whatever, but they're not that good at it. But it's going to come out, and we'll get some coverage. I couldn't even tell you how long ago the podcast was where I looked at some historical. I pulled up different dot plots historically, and I showed what happened a year later or 2 years later, and they were never right. Never right. So don't get too crazy about that. And, that's enough of that. All right. The one last thing with the Fed is, and I don't know why this doesn't get more play, and they have another lever they can use prior to doing something with interest rates. And I remind people, and this is from US Bank, quote, in June, the Fed adjusted its policy, slowing the reduction in its treasury holdings from $60 billion per month to $25 billion per month. So what does that mean? It means as treasuries are maturing. So if you were keeping your balance sheet, the size of your balance sheet the same, if you had a treasury bond, let's imagine one bond was coming off, and they have trillions of dollars. I think they're probably like above 7 trillion still. Yep, they are. They are a little bit above 7.2 trillion, something like that. I guess I could look up the number, but 7.14. Okay, there you go. I just found it. But imagine their balance sheet with just one bond, and it matures at par. So 1 times 100 is, and times 10 is basically the dollar value of that is 1,000. So imagine this $1,000 bond matures. If you were keeping the balance sheet the same, in this case, my very simple answer, $1,000, they would buy a new bond to replace the one that matured, and then their balance sheet would stay constant at, $1,000. So they have many bonds in there. They have $7.14 trillion worth of stuff on the balance sheet, and there's some other things besides treasuries. There's MBS, mortgage-backed securities, and by the way, they continue to trim their holdings of mortgage-backed securities by $35 billion per month. So that's as they mature. I don't know if they've sold anything in the open market. I'd have to check that. But they are reducing the size of the balance sheet, including the MBS, by $35 billion and $25 billion per month. So at this point, they're doing, what is that? $60 billion between the two. And remember, they were doing $60 billion a month in treasuries and $35 billion in MBS, so $95 billion. But all this means is, so as you're letting those run off, you're reducing the size of the balance sheet. Their balance sheet was almost $9 trillion, and that was, 2013. 2022. Sorry, 4/13/22. This chart goes. Yeah, they were just below 9 trillion. So this to me is a bigger deal because they don't, let's say they didn't want to, and I expect a quarter point. I think that's what they're messaging. And again, this close to the Fed meeting, during Jay Powell's terms, he has not surprised compared to what the Fed funds futures were pricing in. But to me, I'm very curious to see if they mention this, because it would be stimulative to stop letting treasuries run off the balance sheet. In other words, they'd have to, just like my $1,000 bond, if that was the only thing, they would go out and buy another bond to put it in. Or are they really committed to trying to bring the balance sheet down to, pre-2020 levels or even lower? And the argument to reduce the balance sheet is, if you reduce it, then you sort of, you have more dry powder. And, they've reduced it, sure. I mean, nearly $2 trillion is not nothing, but it's still really high. So I don't know. I think in the MBS market, and this is a quote within the thing I was quoting from US Bank, it appears the Fed is more focused on trying to work off its book of mortgage-backed securities. So maybe they'll keep bringing those down. I go back to what we were talking about, though, is that typically when you look at the a 30-year mortgage rate, you look at a 30-year mortgage rate, and then you look at the 10-year Treasury, and typically it's more like 170 basis points between those two, and on average, I think I'm remembering that right. And so what that means is if the current U.S. Treasury rate, the Treasury yield right now, it's about 3.65. You would say, on average, the 30-year mortgage rate would be, about 1.7 above that. So about 5.35 right now. But in fact, the average as of Friday, this is the U.S. bank rate, 30-year mortgage average index on Bloomberg, 6.62%. So it's nearly 300 basis points. And I think that's one of the reasons why the spread is wider, is because the Fed has not been going in there and buying MBS securities. They've been letting them run off. And there's also other reasons why, from a demand standpoint, I'll bore you if I start getting into convexity and duration, all that stuff on MBS. But that's maybe one of the things I'll be interested to see how that spread reacts if they do change anything, or if they decide to stop letting so much in MBS run off the balance sheet. So I don't know why there's not been more talk about that. We'll see. Maybe they'll ask Powell about that. I feel like I'm kind of tired of his press conferences, though. The reporters asked the same question 27 different ways, and I want to know about some other stuff. I think there was a question about overnight reverse repos. That's another area. I could be wrong on that, but I'm just telling you, the reason why they were doing the overnight reverse repos was simply that there was so much demand for short-term treasuries that the yields on the treasury started to fall below the Fed funds target rate. And that's why they had to step in and basically provide more supply of treasuries. And an overnight reverse repo simply means the Fed takes collateral and gives it to, let's say, a bank, and the bank gives them cash. And instead of the bank having to go out into the treasury market and buy something, they just do this overnight reverse repo. That's all it is. Don't complicate it. People are making a big deal about this. I don't think it is. Could be wrong, but I don't think it is. All right. The other thing I want to talk about is just what I'm seeing in volatility markets and what I'm seeing as far as, within some of the options chains. Part of the reason why when that move was going on was it this week? It was this week, wasn't it? I feel like the weeks blend together. But the CPI report comes out, the market sells off intraday, it starts to get a little bit nasty. But the thing is, the VIX and the VIX futures never really got crazy commensurate with the level of the move. And, when you looked at it, I looked intraday, and one of the things I watch is the high yield bond spread. The high yield bond spread is just simply, what is the yield to maturity on high yield bonds compared to treasuries? And you look at the difference, the spread between the yield on high yield bonds and the yield on treasuries. And what happens is when things get really bad, you would expect that to bond yields to quote unquote blow out, or the yield spreads to blow out, meaning high yield bonds would sell off, jacking the yield up, and that difference between high yield to maturity and treasuries would widen. Didn't see that. Didn't see it move too much. And the VIX really didn't move last week either. And so intraday, it was, kind of watching it. I saw it coming down to 5,400. I said, I wonder if this is going to hold. VIX not going crazy. High yield spread. It was almost like the ancillary things that typically you'd expect if this was a real move and was going to have sticking power and it's going to break down below 5,400. It wasn't really there. It doesn't really affect how we trade. Our majority of our strategies are, more buffer or hedging strategies. But it is interesting. And although I will tell you there are on the periphery, there's some, when volatility spikes, there's some things that we can do in some of the strategies. We did that last time where we took advantage of some of the moves there. But yeah, I mean, it just was an interesting day, and I didn't see, it seemed like the market was mad, and then it was like, all right, it's not too bad. Want to just briefly touch on the election too. So we just had the second debate, although first debate with these two candidates. And it's a little bit of a different election cycle. And how does it relate to the market? Well, long term, and I've got to update my sheets, but long term, you would say that it really doesn't matter. Like the numbers tell us it doesn't matter who's in office. It doesn't matter who has Congress. It does matter a little bit. You could say, I mean, look, it matters because there's different policies, there's different executive orders, things like that. But the history and the numbers say it's pretty close. It's pretty close. I go back to, by the way, the one construct you haven't had in over 100 years is a Democratic president, a Republican Senate, and a Democratic House. And almost happened last time. I think they had to do the runoff election in Georgia. That would have been close. But anyway, so the reason I bring this up is we'll do a show. So Spencer Wright and I, you might remember, we do our election show. We make predictions. I think we're going to record it Friday, November 1st, maybe, and it will be out by the 2nd or 3rd, right, by the 3rd probably. So we'll do that, and we'll look at some of the probabilities. We'll look at market stuff. But right now, I mean, there are certain industries that are maybe dependent upon one versus the other. And I just thought I'd share, Bloomberg has an interesting chart where what they do is they look at, and in this case, they did Trump's Real Clear Politic RCP poll averages against opponents. So Biden, Harris, obviously the opponents, and in 2016, 2020, and 2024. And I thought it was an interesting chart because basically where Trump is right now, and these are the national polls, and as Spencer and I will go through again, it really comes down to the state and the electoral college, basically Georgia, Pennsylvania, Michigan, but Pennsylvania is pretty much the grand prize there. So I looked, and right now Trump is down 1.5% to Harris, 1.5 points to Harris. So when he won, now at this point in the cycle, so compared to 2016, he was a tiny, almost right where he is now to Clinton. And then you look at this point in the election cycle, he would have been down roughly 7.5 points to Biden. So, and then on election day, I mean, he's basically close to where he was in a deficit to Harris as where he was right now to where he was to Clinton in 2016 and when he won the election. On election day in 2020, he was minus 7.2. National polls, and this is the average, the Real Clear Politics average. So it's when I say it doesn't matter in the long run, it can have some shifts in the short run. A lot of people are expecting volatility. The spread between the front month VIX, which after Friday, where we sort of had a really nice up day, but after Friday, the VIX was about 16.56. It was down again, went up above 17, and that's been coming off. And like I said, even that one day when things, we only got to 22. I say only. I mean, we got above 22 and a half or so on the VIX, the spot. The future was lower, but it didn't really go crazy that CPI day. But we're seeing the VIX come back down. And one of the things you watch for in the polls is over the next couple of weeks, what is the deficit and how is that relative to where he was in the other elections? And then you look at the states. So we'll talk more about this. And I got to update my spreadsheets. I'll do that probably this week, and I'll share it on next week's show. Just the average annual returns in different structures. So when you have Republican president and then Republican Congress and Senate and vice versa, and you have these mixes and matches. And I'm also going to run what the cumulative inflation has been I'll do it for Biden Harris, I'll do it for Trump Pence, and maybe I'll go back to back to Carter, maybe Carter or Ford. I don't know. I'll go back kind of far, and I'll look at the cumulative inflation. And I'm curious to see when you have higher cumulative inflation, if a candidate has won or the party has won re-election with that. So I'll do that. I had people asking me, and I pulled out my spreadsheet. I'm telling you, I took probably hours on a Sunday to do this and go back historically and build the different models and build because I wanted to look at the construct. It's easy to get, what are the returns by president? But it's not as easy to get, hey, what happens when you have one president and other parties in power in the Congress and the Senate, and then it changes in 2 years. So it took me a lot of time to do it. I'll update it, and I'll put those out. I'll talk about it next week. But I think, we'll see if we have another debate or not. The thing I would watch with the elections is there's still at least priced in. So remember, we talked about pricing in future Fed cuts, and the market has sort of talked itself into that. The front month VIX is, what did I tell you, of 1656? I think there's, about 1656. If you look at October, the October future was about 18 and a half. November was about, 18 and a quarter or so. So there's kind of a big spread right now. And that election volatility, I'll call it, is still there. It's still there in October and November. So what does that mean? What that means is if you're buying options or selling options, they are pricing in a higher probability of a greater range, because when volatility is high, the premiums are higher. Basically, it's saying that on an annualized basis, they think the annualized standard deviation is going to be higher than it is in even the current spot month. So one of the things I'll be watching is to see if those numbers budge, because we're starting to get up to where spot, where we are right now, that's the one you see on CNBC, and the future. And, the October contract, I believe that's about 30 days out now on the future. So I want to see typically spot on the future. Eventually, if you get to expiration, they sort of converge to each other. And the question is, does the future come down to meet the spot, or does the spot go up and meet the future? But right now, options premiums are a little bit higher in the next couple of months because of that embedded expectation of volatility. And the funny thing is too, I don't know what's going to happen. I really don't, as far as the volatility. And I shouldn't say that, because I caution against seeming like that I don't really know what's going on, or I don't have opinions, or I don't have predictions. I have it all the time. the point is that, it seems like everyone is saying, like if you watch CNBC, they're all saying, well, we expect volatility around the election. We expect volatility around the election. Remember, 29 out of 30 leading economists said there was going to be a recession in 2023. So, and right now we're seeing all these embedded rate cuts in the Fed funds futures and the probabilities. The crowd sometimes is wrong. That's why it's good. Just be invested, be hedged. Just let you stay in the market. Don't try and time things. All right, I'm going to call it there. And next week, Jay will be back with me. It will be a post-Fed show, and we'll get to critique Jay Powell or not critique him. And we'll see how the media ask him 18 different ways the same question. But it's it's a big week. It's a Fed week, and it's been a while since we had a Fed. I'm assuming they're going to lower at least a quarter point based upon the Fed funds futures. Been a while since we had an action meeting, an actual meeting where they did something. So they're going to do something. I want to hear what they say about the balance sheet, or if maybe they don't. Maybe I'm the only one who's watching it. And let's see what the dot plots say. Always curious about that. And their unemployment and all the stuff that's going to be wrong. We know it's going to be wrong. All right, that's it. I'm done. I'm trying to think what I watched this week. I continue to watch Bad Monkey with Vince Vaughn on Apple TV Plus. I'm enjoying it. But come on, Apple Plus. Come on, Apple. Like, just dump all the episodes. Just give it to us. Like, really? Now I got to wait another week? And the way I watched it was, I think I watched the 3 episodes altogether, the first 3, because I waited. But now that I like the show, I want to keep watching it. Just give us the shows. Like, do what Netflix does. Just dump the whole season. I think Amazon Prime does that too. I don't know why they do it like that. I think Paramount does that too, where they give you a show and then... So, I don't know. Just, I'd rather, maybe I'll send Tim Cook a letter. Does anybody write letters anymore? I don't know. That's it. I'm out. Talk to you next week. I'll be back with Jay. We'll figure out what else we got wrong or right. See you, everyone.